Well, good afternoon, everyone. Cynthia Tomaine here with Interactive Brokers, and thank you for joining me for today's installment the May installment, I should say, in our running series, The School of Futures. Today, we're going to be covering an introduction to the interest rate complex. Now, I'm very pleased to have with us this afternoon Pete Mulmat, who's going to be delivering the presentation. So, Pete, I'm going to move this over to your slides. If you can unmute your phone, let's get started.
Great, Cynthia. Thank you so much for the introduction. And again, CME is so pleased to be working with IB to bring information about futures products to its active trader population. And we've got a lot to cover today. We're going to be talking about the CME Group's offering of interest rate futures, which are both short-dated and longer-dated trading products. So there's a lot to go over, and let's just start getting into it. So again, brief view of the disclaimer. You guys have all seen this probably too many times to count, but futures do have risk associated with them, and they are a leveraged product. So I'll give you a minute to kind of peruse this, and we'll jump on. Let's talk about the agenda of what we want to accomplish today. And can everybody hear me okay? Is the volume good? I just want to make sure people can hear me. Can I get a response? Ask you guys. Everybody hear me okay? Thank you. Great, guys. And can you see the other quick question I have for you, can you see the laser pointer? I've highlighted the laser pointer. It should be out there. Thanks, Dimitri. I appreciate you responding. And you can see the laser pointer. That's great. So we're going to be talking about both short-dated and long-dated Treasury futures today. And we're going to start with Fed funds and Eurodollars, which are 30 and 90-day short-term instruments. And then we're going to talk about US Treasury futures that are traded on the exchange, 2s, 5s, 10s, what we used to call the 30-year, but it's considered the classic bond now with a 15 to 25-year delivery, and an ultra bond, which is a 30-plus year delivery. We're going to talk about some resources, and CME Group has some great resources for finding and helping you understand some information about Treasuries, how Treasuries are priced, and also, if you're looking to trade these products, there's some great resources in terms of, and I'll cover these, figuring out how to weight ratios on spread trades in terms of computing, and we'll talk about this a little bit more, the dollar value of 1 basis point across different products. And one of the great things you guys all have access to is really one of the best online execution platforms in terms of Interactive Brokers. They are offering all of our products. There is tremendously easy, efficient access to both see our active equities, our active interest rate suite, as well as be able to analyze, chart, and do studies on them. So I encourage you guys all to go back to the Trader Workstation, take a look, and check out these products, because the ability for you to analyze them and put your strategies into play, IB has facilitated really an incredibly efficient and robust platform for you guys to do that. So really, what is the, again, throughout this product situation, what are some of the users who are looking to trade interest rate products? They're both hedging and speculating. Institutions like a bank or a company that needs to borrow money in the future will hedge that interest rate exposure, and then there are individual and companies and groups that will speculate, and they're looking for a return on their ideas in terms of putting on trades with a directional basis to them. So what we're going to talk about today, and a lot of this, and guys, if you have questions and I'm covering stuff that maybe if I'm going through too quickly, I'm going to keep an eye on the chat box, because what we're talking about here is, again, looking at yields of different instruments for different maturities and the pricing conventions of them, which oftentimes is a reciprocal of the yield. So in other words, when we look at a rising yield of an instrument, the price of that instrument and the way it's traded, the way it's quoted in the futures market or even the cash market, is the inverse. So there's a lot to think about here in terms of the relationship of the products to kind of the terms we talk about in terms of the inverse relationship of yields to price. So as we go through this, if people want a little bit more explanation, please let me know if you have any questions in the chat box, and I'll try to address them as we go along so we don't get too far ahead and get too confused. But what we're going to be talking about a lot is that these different instruments all have different yields, everything from a 1-month, 3-month out to a 40-plus year yield. And yields, depending on what a yield curve shows us here, and this is a normal upward sloping yield curve. And most of the time, the yield curve is upward sloping. And what it reflects is investor expectations of economic growth and the possibility of inflation. So as an instrument goes longer in maturity, people who are providing that instrument or are loaning that money for a longer time frame are usually required to get to know the fact that the longer term the yield, the more the variables are in terms of we don't know what inflation is going to be, what the economy is going to be. So usually this yield curve is sloping up. So the longer term the yield is, the more investors are going to require from borrowers to provide that capital. So let's take a look at an inverted yield curve, and this occurs when short rates are higher than longer-term rates. So let's look at this, and we can see here the 3-month rate is at 7%, and as we go down the yield curve, we can see that yields are declining. And we've seen this situation happen in the early 80s when the United States was facing severe inflation, and the Federal Reserve was attempting to break inflationary expectations, so they raised short-term rates dramatically in an attempt to squeeze inflation out of the system. So this is an inverted yield curve. We really usually don't see this except for when there is really dramatic exogenous effects on the rate environment. And this takes a look at, again, what I've highlighted a bit is the availability. And this is what's great about futures is you can express your view. You can create strategies across everything from a 30-day Fed funds contract to a Eurodollar contract, which we'll talk about, which is a 90-day benchmark yield, all the way out through 2s, 5s, 10s, our classic bond, all the way to the ultra bond. So there is all kinds of opportunities to, depending on your view of both long and short-term rates, how do I create strategies that best fit that? So let's take a look at our two, what we call STIRS product, and STIRS stands for short-term interest rate. So let's go ahead and take a look at our first contract, which is a Fed funds contract. It's 30 days, and what are Fed funds? Fed funds are the interest rate at which banks lend funds maintained at the Federal Reserve to one another, and it's the overnight rate for that. Fed funds rate is generally only applicable to the most creditworthy institutions when they borrow and lend overnight funds to each other. The Fed funds rate is one of the most influential interest rates in the U.S. economy, since it affects monetary and financial conditions, which in turn have a bearing on key aspects of the broad economy, including employment, growth, and inflation. The FOMC, or the Federal Open Market Committee, which is the Federal Reserve's primary monetary policy body, telegraphs its desired target for the Fed funds rate through open market operations. This is also known as the Fed funds rate. We will also then talk about Eurodollar futures, which are 90-day futures. They are, Eurodollars are U.S.-denominated deposits. The 90-day rate for those outside the country of origin. So in other words, Eurodollars are U.S. dollars deposited anywhere outside the United States, anywhere from the UK to Bermuda, France, anywhere. So if we talked about a euro-yen rate, it would be, what do I get for 90 days for my yen deposits outside of Japan? So I'll go into that in a little bit more, but let's take a look at, again, one of the things we're going to wrestle with as we learn about this is how are these all quoted? And there is, for short-term interest rates, there is what's called the IMM quote. And it was developed in the early 80s. And again, it goes back to this idea of putting a quote or a pricing convention into play that traders can use. And this happens to be, again, we'll walk through an example of this, but prices move inversely to yield. If rates go up, prices go down, and conversely, if rates go down, prices go up. And this convention allows instruments that traditionally traded in yield to be traded by price, much like many other commodities. So if we look at our contract specs for our Fed funds futures, they have a $5 million notional value. So each contract you control is for $5 million notional of the product. It is, again, quoted in terms of 100 minus the yield. So we will go through some examples of that. It's traded on a quarter of a basis point tick. For the nearby month, a half basis point tick, which is equal to $20.83 for all the deferred. And why are we talking about this Fed funds futures? And what I want to do is, right now we're in a zero interest rate environment. You guys have all been trading in this environment for quite some time now. Within this environment, as this dynamic starts to change, and we've seen rumblings out of the Fed's sponsor this week actually started to talk about how the Fed is going to extricate itself from a zero interest rate environment. And as we start to see that, one of the first ways the market will start to get a sense of expectations is through where Fed funds futures are traded. So I kind of put this up here so it's on your guys' radar screen. As this environment changes, you're going to get an initial sense of, as the Fed fund futures start to move, whether or not we're going to see movements in other parts of the interest rate curve. So, and there are 36 months of consecutive contracts for Fed fund futures listed. So if we take a look here, what we can look at is, again, the price quotation. It's 100 minus the yield. And one basis point, and remember, the first month or nearby delivery trades in quarter basis points. Everything else trades in half basis points. But we can see here that the pricing convention, which is the settlement here, the last traded price for the day on January 30th, is 100 minus the yield, which was 0.0725, gives us our price. So we start to see how yield here at 0.0725 equates into a tradable price. And this gives you a sense of the volume and open interest, which is open commitment or overnight held contracts for this. And what we're going to try to get a sense for, and there's a great tool CME Group has on its site, is to look at the Fed funds movement, and it will kind of give you it's a great tool that will give you a sense of where the market believes we're going to start to see changes in rates. So the U.S. is rather unique, and amongst World Central Bank is that it has a dual mandate. It's mandated both with facilitating economic growth as well as restraining inflation. So targeting the Fed's funds rate is, as I said, its most significant policy tool. And with our current environment of zero interest rates, we have been told we will see this zero interest rates until we see some inflation and pick up in jobs creation. We're starting to see that. We're starting to see the participants talk a little bit about that. So we'll see how that may change. And if we look at our futures curve here, which is basically looking at each month and where the pricing is for it, we're seeing a upward sloping curve. So what is the prediction here? What is the market telling us by terms of this forward pricing is that there is an expectation as we roll into the middle and end of next year that we're going to start to see a change in the Fed funds curve. So one of the tools I was telling you about is accessed right here. It's at www.cmegroup.com/trading. It's a Fed Fund Watch tool, and it is a very interesting tool that will let you, the tool lets you quickly gauge the market's expectation of potential changes to the Fed funds target rate. The CME Group FedWatch is based on the 30-day Fed funds futures prices, which have long been used to express the market's views on the likelihood of changes in U.S. monetary policy. FOMC meetings are matched with the corresponding 30-day Fed funds futures contract, and then probabilities are assigned of possible Fed fund target rate changes, and they're calculated going forward. So the probability of a rate hike is or change in rates is shown here based on that curve. So again, as that curve changes, we can get a probability or an expectation with this tool of the likelihood of rates changing. And that's something we want to keep whether we're trading equities or any products. We want to keep a sense of where are expectations for Fed policy, because as Fed policy changes, our investment and trading strategies may change along with that. So this tool is a great tool to start to track and follow where the market, through its pricing of Fed Fund futures, believes we're going to see changes in interest rates. Let's go ahead and start to talk a little bit about our Eurodollar 90-day contract. It is a U.S. dollar-denominated, what it consists of are, as I said, is U.S. dollar-denominated deposits at foreign banks outside the United States. So this is the 90-day benchmark borrowing rate for deposits outside of the U.S. Originally, dollar-denominated deposits were not subject to U.S. banking regulations and were exclusively held just in Europe, hence the name Eurodollars. But these dollars are still, to a great extent, held in Europe, but they're also held in countries such as the Bahamas, Canada, Cayman Islands, Hong Kong, Japan, the Netherlands, really everywhere. And so any of those dollar-denominated deposits outside the U.S. are considered Eurodollars. So let's take a look at, Eurodollars were launched in 1981, and today the average daily volume in our Eurodollars, our 90-day Eurodollar contracts, average about 2.36 million contracts. It is by far our largest traded product. 98% of Eurodollar futures volume is done electronically via Globex, and you have access to through the Trader Workstation. Some of the users who are using it: commercial and investment banks to hedge interest rate exposure, prop traders, proprietary traders are making markets and trading the curve. Eurodollars trade out, there are 20 years worth of listings on a quarterly cycle, so the ability to hedge short-term interest rates 20 years out in the future with liquid and deep markets is of benefit to both asset managers, mortgage providers, regional banks, and some of the users are people who are adjusting possibly duration in a bond fund. Really, what we want to think about are traders looking to create trades to shape around a yield curve expectation, and also ways to outright take a position in where we think interest rates are going. Let's take a brief look at our contract specs for our Eurodollar 90-day time deposit futures. They have a $1 million face value, and they trade, again, on this IMM index, so it's 100 minus the yield. So, again, if the yield were 0.85, as we've shown here, the price would be $99.15, which is 100 minus that yield, gives us the tradable price. The tick size is 1/2 a basis point, or $12.50, except for the nearest quarter, where we trade in quarter of a ticks. And Eurodollars trade on a March quarterly cycle. Many of you guys who are trading equity index futures are familiar with that cycle. That's the March, June, September, and December cycle. It extends out 10 years. There's 40-plus contracts, plus there are serial months within that cycle. Again, you're afforded access to Eurodollar futures on Globex starting Sunday night at 5 in the evening and running till Friday afternoon at 4 in the evening. And that's Chicago time. Eastern time would be 6 o'clock Eastern time Sunday night to 5 o'clock Eastern time Friday night, with a 1-hour break from 4 to 5 each day. So again, let's just refer and refresh this idea of pricing. So we're always looking at how do we get our IMM index quote. That comes from, again, taking our benchmark of 100, subtracting the yield, and we come up with our pricing quote. So now we can start to understand how these are quoted. When I call up a June Eurodollar future on the Trader Workstation, what am I looking at? I'm looking at a price quote. How do I determine yield from that? It's the difference between 100 and the price quote gives you the yield. And again, the one basis point move going from 99.15 to 16 is equated to $25, We trade in half ticks, so that would be $12.50. So again, we have 10 years of 40 quarterly contracts plus 4 serial contracts and the ability to spread. So as short-term interest rates start to move, the ability of spreading out across 40 products creates tremendous strategies for individual traders to look at. You're always looking for those opportunities where I have liquidity, access, and then movement. And as we start to see this short-term component of the yield curve start to move as Fed policy shifts, I think we'll start to see tremendous opportunities amongst these markets in terms of spreading opportunities. And this is an example of where the Eurodollar curve, and we delineate, if you look here, you see white, red, green. As we go out to 10 years, there's 4 quarterly cycles. Again, this first white would be June, second white would be Sep, Dece, and we would then run into March of next year. So to clarify this, they are listed in terms of color when they designate them. White for the first 4 months, red for the next, green for the next, the following. When you look for them on the trader workstation, you're going to find them in terms of that year attached to them. So if I was looking for a red or second-tier euro, it would be considered a June of 2015. So we would be looking at the GE, which is the symbol for Eurodollars, GE, and the month symbol would be M, and it would be 5. So GEM5 would be for the June of 2015. So again, just to review this reverse pricing convention, for short-term interest rates, if we want to express our opinion and we feel that there are rising rates and we either want to hedge exposure or expose ourselves to the opportunity of rising rates, we would be selling Eurodollar futures as hopefully rates rose. Conversely, if we wanted to hedge a declining interest rate environment, or we wanted to speculate or trade on the fact that rates could decline, we would be a buyer of Eurodollars. So again, that inverse relationship. We also have options on Eurodollar futures. And for many of you who are very familiar from the equity options or the ET options world, options on futures, Eurodollar futures, again, provide you more tools in your toolbox to express your opinion in a defined way, taking advantage of either what you perceive as high volatility or low volatility. They're incredibly liquid. They're trading over 2 million contracts a day, so your ability to create and manage strategies, it's the perfect market. And again, we have a whole series of rather involved options on futures for Eurodollar strategies, so you can actually trade them as groups. They're called packs. They're called bundles. And it's something that if you're looking for those more advanced strategies, there's liquid and deep markets in them, and I would suggest that you spend a little time on CMEGroup.com to see the availability of those option strategies. And here's a great tool, and I want everybody, if they can, to take a look at this when they get a chance. It's our QuikStrike tool, and this is an options valuation tool. It lets you get concise volume and open interest. It lets you do some options pricing analysis, lets you do spread pricing analysis. And what's great is this QuikStrike tool is available for all of our products that have options on them. So if you want to trade equity index options, you can use the same tool and just go to the ability, and we can see here we're choosing Eurodollars. There's also our Ultra Bond, or 30-year or 10-year, all the way down the curve. So you can use this QuikStrike tool not only for the interest rate complex, but for all our complexes to start to evaluate, and it's a great tool to help you price options and strategies. So let's spend a minute now. We've talked about our STIRs, or our short-term interest rate products. Let's go and look at our benchmark Treasury products. We have a 2-year note, a 5-year note, a 10-year note, classic T-bond, which we used to call the long bond or the 30-year. It's now not called the 30-year. It's because the delivery basket is between 15 and 25. It's called the classic T-bond. Then we also have the ultra T-bond, which is 25 to 30 years. And we can see here again, here's the yield curve roughly the yield curve as of the beginning of the year, I believe, and we can see that we have products that are tradable all along this yield curve. That affords us the opportunity to express our view either on shorter-term interest rates or longer-term interest rates. Again, volume, our volume in our products is, our greatest volume is in our 10-year notes, but you can see that there is large volume, there's liquidity in all of our products across the entire interest rate curve. Let's talk a little bit about the products themselves, because one of the things we want to know when we start to look at futures is the face amount, the contract values, and when they're traded. So this is a great summation of our benchmark Treasury products offering. So again, as I told you, we have a 2-year note, we have a 5-year, a 10-year T-bond, classic T-bond, and an ultra or a long-term T-bond. They all, except for the 2-year, they all have the same face amount or notional amount of $100,000. We can see here below the variance in delivery maturity. There are what they call a grade of deliverable products that vary in years, but they all fit into this equation of what we consider each of these products. Do notice that the 2-year note is twice the notional amount of the other products, and that figures into, because it's a the movement of yield on that is much smaller. To make it more efficient, it's a larger traded product. They all do trade on the same quarterly cycle we've talked about, March, June, SEP, and DEES. Again, they're available on Globex from 6 p.m. Eastern Time, Sunday night, through 5 o'clock in the evening, Friday night with a 1-hour break from 4 to 5. And a little bit of what we want to talk about, and when we go through the examples, we'll look at this, are the tick sizes. Now, when we look at Treasury prices, we're going to go ahead and look at them, and they're quoted in 30 seconds of a tick, and we'll go through some of those pricing conventions in a minute. But for 2 years and 5-year notes, their minimum tick size is 1/4 of a 30-second, and in the 2-year, that equates to $15.62. In the 5-year, again, we're trading at 1/4 of a 30-second is our minimum tick, and that tick size is $7.18. The 10 years traded half a 30-second, or half a 30-second is the minimum tick size. That's $15.62.5 per tick. When we go to T-bonds and ultras, they trade at 1/32 of a point, and that each is at $31.25. So again, we've kind of highlighted here the difference in tick values and tick sizes. Since the shorter dated instruments trade at a smaller movement in tighter ticks, and the movement amongst them is less, we tend to afford smaller minimum tick fluctuations, so you can really take advantage of perceived smaller moves in the market. So let's take an example, because we talked about a lot of terms here. We talked about a lot of different ticks and stuff. Let's just take a quick example of a trading example. So in this example, a trader believes that the U.S. economy is strengthening, and intermediate term treasuries, we'll call them 5-year treasuries, their yields will increase. So if we think yields are going to increase, what's going to happen to treasury prices? Anybody got a guess? What's that inverse relationship? If yields are increasing, what are prices doing? Anybody want to throw out a guess on the screen? Yields are increasing, prices are going to go up or down. There you go. Thank you very much. Thanks, Sheng. Thank you, A. Appreciate it. Prices are going to go down. Good, you guys. That's the, that is the hump that is different than a lot of our other markets. Is, if I'm bullish crude, prices are going up. Here we're looking at the inverse. Thanks, guys, for responding. So what's the trader going to do? He's going to sell, and let's just take an example, 10 contracts of our March 5-year T-notes at 120 and 25/30 seconds. So the way we trade them, again, is not in yield, but in price, and it's in a benchmark price plus a 30-second of a yield. So the trader sells his 10 contracts, and he's correct. The economy is strengthening. Yields go higher, prices go down, and he buys those 5 years back at 120 and 3/30 seconds. So what did he make on that trade? Just so we can get comfortable with the tick sizes, The tick size for the 5-year note, again, is 1/4 of a point. It's 1/4 of 1/32 of 1 point. So each point is 32 30-seconds. So 1/4 of 1/4 of 1/32 is the minimum tick size. So the dollar value of that minimum tick size, remember, is $7.81.25. So what did he make on the trade? He sold the T-notes at 120, 25, 30 seconds, and he bought them back at 330 seconds. So he made 22 30-seconds, or 22 points, excuse me, 22 30-seconds on this trade, times the 1/4 of a tick size of that, so times 4, or he made 88 ticks on this trade. 88 individual ticks, or 22 30-seconds. And for this example, the profit on that trade would be the contract, 10 contracts is what we traded, 88 ticks is what we figured out the profit to be, times the tick value, or $6,875. So in this example, that walks us through the tick size. Let's take a look at another one for another product that has a slightly different tick size. So a trader is going to buy, the payroll numbers come out on Friday, and they're weak. So again, if we think the payroll numbers are weak, the economy is slowing, chances are rates are going to go down, and as we know, inversely, bond prices may rally. So if a trader thinks that he's going to buy 10 contracts of the March 2014 10-year notes, he's going to buy them at 125 and 530 seconds. Excuse me, at 15 30 seconds. He's correct in his assumption. The market rallies and he sells them at 125 and 23 30 seconds. So again, remember the tick size for the Treasuries is 1/2 of that 1/32 of a point. So it's 1/64, so to speak. Again, the dollar value of that minimum tick size is 1562. So what did the trader make? He made 7.5 ticks, the difference between 23 30 seconds and 15.5 30 seconds, times 2, because it's at the ticks are 1/2 or 1/64. He made 15 ticks. So we take the 10 contracts times the 15 ticks times that tick size, and he made 23.44 on that trade. So again, let's spend a minute and let's review a little bit of what are some of the drivers that affect Treasury prices. Again, if we see the economy strengthen, we can see increases in interest rates because more people are going to want to have access to funds to invest and to expand. So we're going to see increases in demand for loans. We could see increase in interest rates. We could also see an asset allocation out of bonds and into stocks as they perform. So as we see an allocation out of bonds, people will sell bonds, causing bond prices to fall and yields to rise. And if we see the economy growing, we could likely see as the economy grows and we get inflationary pressures, we could see an increased likelihood of interest rate increases by the Federal Reserve. So when will we sometimes see Treasury prices rally? Oftentimes when the economy weakens. We're going to see decreased demand for loans. We're going to see asset allocation out of stocks and back into bonds, so buyer of bonds driving yields down, and we could actually see a likelihood of the Fed coming in and lowering rates. So these are some of the interplays between the economy and what can drive rates a little bit. So one of the things we've talked about a little bit here is the idea of we have these products, we have these different maturities all across the yield curve. So how can I, as an active trader, look to deploy a yield curve trade? So what are some of the things we need to do to start looking at this yield curve trade? And the first thing, like with any trade, we sit down, we try to come up with a strategy or an outlook. What we believe is going to happen basis our fundamental and technical analysis. We're going to develop that yield curve outlook. We're going to talk a little bit about that spread logic. So if I have a view on the yield curve, how would I express that view? And then we're going to talk about something that is important and will require a little thinking, but we actually, CME's got a great tool to help you with this. We want to express our view on these products that, may have different notional values, not notional values, but the dollar value of a basis point across different yields may vary. And so how do we construct and weight a spread trade? So we're going to look at that and the concept behind it and a little bit, what's a tool I can use to figure out the dollar value of a basis point, what is it, and then figure out how do I construct that into my spread trade. So again, we'll go through this, and all these slides, as Cynthia said, I'd be so wonderful to provide all this. I know I'm going through a lot here, and hopefully you guys can reference back to this and take a look and see some of these strategies and some of the tools available to you and get a clearer picture on this. So what are we talking about when we talk about a yield curve trade? We're talking about the difference, playing the differences in different maturities. So we can look here at a 5-year yield chart and a 10-year yield chart, and we can see that the markets move in a similar fashion, but sometimes to a greater or lesser degree, and that's as expectations for inflation, expectations for demand for borrowing out into the future change, and risk changes, the yield curve changes. So we see that component of time come into effect. So this is a resource where you can go and actually just jump ahead a slide, because here is the resource this is put out by the Treasury Department, and you can actually go out and choose a date, enter a comparison date, and actually it will chart the yield curve for you. So if you want to start looking at the yield curve across different maturities, it's a great resource to take a look at. So again, what do you want to do when we start to do this? Our first task in designing a yield curve trade is to decide how you expect the Treasury yield curve to react to interest rate developments during the term of your trade. In general, when yields are falling, the yield curve will steepen. When yields are rising, the yield curve will flatten. These shifts happen because shorter-term yields typically respond more to an event like a Fed policy shift than do longer-term yields. It's important to note that from time to time, though, events can interrupt normal yield curve dynamics. For example, the Fed may be in a tightening mode, which would normally lead to a flatter Treasury yield curve. However, if the market concludes that what the Fed is doing will not be enough to control growing inflation, longer-term yields, which are more sensitive to inflation fears than shorter-term yields, may rise more than shorter-term yields do. If this happens, the yield curve could steepen, even though yields are rising. The yield curve, as we've said, displays equivalent yields of the cash Treasury benchmarks by their respective maturities. The yield curve fluctuates. Many factors affect the shape of that yield curve, including trader and investor expectations for inflation, economic growth, Federal Reserve open market policy, and even geopolitical tensions. Participants in the Treasury futures markets can use futures contracts to manage yield curve risk as well as take advantage of changes in the yield curves. The basic concept is to spread the yield curve using futures. The logic of spread trading is really pretty straightforward. If you expect the yield curve to steepen, you typically want to buy the spread. If you expect the yield curve to flatten, you will want to sell the spread. You either buy or sell a yield curve spread in terms of what you do on the short maturity leg of the trade. So again, the shorter maturity leg in this example would be the 5-year leg. The longer term maturity leg would be the 10-year leg. So if you expect the spread to widen, i.e. the spread to steepen, in other words, 5-year prices to move away, to rally more than 10 years, or remember, when we talk about this, we're looking at this in terms of prices. So when we say the yield curve moving out, that means that 10-year yields are going to rise faster than 5-year yields. So when we convert that back into prices, we're looking at the curve to steepen. In other words, the 10-year versus the 5-year futures, that number to widen out. So if you expect the spread to widen or steepen, you can buy the spread by going long the 5-year Treasury note futures and short the 10-year Treasury note futures. When the yield curve steepens, the 5-year Treasury cash yield will fall, relative to the 10-year Treasury cash yield, and the 5-year note futures price will rise relative to the 10-year note futures. A long position in 5-year note futures will gain more than a short position in 10-year note futures will lose. This example shows that a 20 basis point drop in the initial 5-year cash yield of 1.99% boosted the 5-year futures price by 30 seconds. At the same time, a 10 basis point yield drop in the initial 10-year cash yield of 2.96% boosted the 10-year note futures price by 24 seconds. Remember again that the 5-year note futures trade in points and quarter 30 seconds, whereas the 10-year notes futures trade in half 30 seconds. Now, if you expect the yield curve to flatten, you can sell the spread by going short the 5-year note and going long the 10-year note futures, because the 5-year note futures price will fall more than the 10-year note futures price. The short position in the 5-year note futures will gain more than the net long position, and the 10-year note futures will lose. So this is spreading these markets when you're doing it in equal amounts. Now, one of the things we want to look at and talk about is how do we filter out extraneous effects? How do we just play not in, if the market in yields or in Treasury prices all move at the same time, how do we affect, and they move at an equal amount. If the curve, while it moves, the curve itself, the shape doesn't switch, we want to expose ourselves to changes in the curve, not necessarily changes in the overall market. So we want to filter out the extraneous effects of markets just rising or falling. We want to express our view. We want to create a view in just the yield curve movement. So true yield curve spread trades filter out directional effect, i.e. changes due to parallel shifts in the yield curve. And a true yield curve trade responds only to changes in the slope of the yield curve. And we've looked at that slope a little bit, or what we call non-parallel shifts. Suppose you bought the spread only to see the 5-year and 10-year cash yields drop both by 10 basis points. You would see that your effect on your position would not be equivalent. You want to be able to spread your position, that is, be long 5-year futures and short 10-year futures. In this example, you would have actually lost money doing that, even though the yield curve has not changed in shape. So this is not the outcome we want. We want only to express a profit or loss when the structure of that yield curve changes. So we want to filter out this directional bias. And how do we do this? We need to create a spread ratio or structure the products so that the shorter-term maturity futures position offsets any losses or gain in the longer-term maturity futures position when the curve moves in a parallel manner. So what we need to do is to figure out the dollar value of a 1 basis point move in each instrument. There's a great paper here if you guys want to delve more into this, and I know I'm putting out a lot here, so I want to give you guys some resources where if you want to explain this a little better, understand this, and have the time to consume all this, you can get it. There's a great paper here at CME that explains the dollar value of a basis point, and really why do we want to figure out the dollar value of 1 basis point? And the fact that we have to understand is that 1 basis point value is different depending on maturity. So if that value is different, we need to take that differing in value into our spread relationship. So the dollar value of 1 basis point indicates approximately what one futures contract will gain or lose in dollars for every 1 basis point change in yield. So we want to match up the dollar value of a 1 basis point change in yield of the shorter term maturity against the longer term maturity position. Now there is a formula, there's math to do that, but honestly, here's the great part. At CMEGroup.com, you go to interest rates duration tool, and it will compute for you in real time the dollar value of 1 basis point. So we can look here and we take a look. TU is the symbol for the 2-year, FB is the 5-year, TY is the 10-year, US is the classic bond, UL is the ultra bond or long bond, and right now we could see here, and we'll plug this into an example, it will give you the dollar value of 1 basis point. So again, if I want to start constructing a true yield curve trade, I need to weight the legs of my, in this example, 5 and 10-year spread. I need to weight those legs. This tool will do all that math for you, so you'll know exactly how to weight the legs. Once we have the dollar value of 1 basis point, we can then go and figure out what our spread ratio is. So we know from our tool that the dollar value of the 5-year currently is 46.61. That's the dollar value of a 1 basis point move. In 5-year yield, we can see here 65.09 for the 10-year yield. So if we take those two numbers, we can then figure out our spread ratio and how many 5 years to 10 years should we have on. So what we're going to do is divide our 5-year dollar value of 1 basis point by our 10-year dollar value of 1 basis point, and we come up with 0.7160. So if you want to strictly express your view, not on the rates in general, but the relationship between the 5 and 10-year, and only trade that, you would actually go long 10 contracts of 5 years and short roughly 7 contracts of 10 years. So to expose yourself to just the yield curve movements, you want to use the dollar value ratio spread of this. So this tool, and we'll go back and look at it again, and we can see where those numbers have came from, 46.61 and 65.09. When you just do the simple math of dividing one into the other, it will tell you the ratio of contracts you should use. So again, you will be using more contracts of the shorter dated instrument and fewer of the longer dated instruments. But this 10-to-7 ratio, again, now, if you see parallel movements in yield across the curve, you won't be exposed to any profit or loss. What you will be able to do is when that yield curve changes and moves over time, then you'll be expressed to that. So just to summarize, and again, a yield curve is a spread trade. It's a speculative spread trade, but it shifts the burden of speculation from taking a position on interest rate or price direction to taking a position on what you expect the yield curve to do. This gives you an extra way to be right, so to speak, for you have no concern for rate or price direction, only for yield curve steepening or flattening. Further, because spread trades implemented with US Treasury Futures can receive margin credits or reduced margins, this type of strategy can be a low-cost means to capitalize on your yield curve outlook or to defend your portfolio from adverse shifts in the yield curve. Also, again, we have a great offering on options on US Treasury Futures. So, again, if you're looking for more tools to use options on futures, our open interest and ADV in all these, again, all the products we talked about, the 2-year, the 5-year, the 10-year, the classic or 30-year bond and the ultra bond, we all have very good liquidity, the ability to execute strategies. So guys who are coming from that, traders coming from that space where they're trading options on either equities or ETFs, looking for opportunities using options on futures can provide you that access and market efficiency you're looking for, as well as the ability to express your opinion. So the one thing, again, with all options on futures, I just want to go through real quick, is that options on US Treasury Futures deliver into a futures contract. It doesn't deliver into an actual note or bond, it delivers into a futures contract. So you need to be aware with all of our options on futures product, they always deliver into the underlying contract. So if you had an equity option in the S&P 500, an option on a future, it would deliver into a March or June, a June or SEP currently underlying futures contract. The same way a crude option on future right now, a June crude option on future would deliver or be exercised into the underlying June futures contract. Just to take a look, again, we've talked about the growth in volume in our products. This is the ADV of both our electronic and pit-traded product. The electronic product growth in terms of executing these strategies on Globex through the trader workstation has grown tremendously. The majority of the volume now is being done electronically on the screen. And I just wanted to highlight, and again, you guys can refer to this, CME has a tremendous amount of resources for you guys to take a look at, to view, and see some of the tools and some of the resources that we have for you guys to learn more about trading Treasury futures and also to get some insight into the markets themselves. And I know I'm bumping up against the time a little bit. I wanted just to thank everyone for kind of riding the wave with me. I know there was a lot we went through. It was a lot to cover, and I hope it has brought you a little bit more information in terms of trading our products, the availability of our products, and the breadth of our product offering in terms of interest rate futures. I want to see if anybody, in the couple minutes we have left, if anybody has any questions, please feel free to ask them now. If not, feel free to reach out to me. This is my email address. At any time, I'd be happy to get into any of these concepts, review them with you, or get to them more in depth, or show you some tools and resources where you guys can pull some more information out. Well, thank you, Mark. I appreciate that. I know it was a lot, but I appreciate you sticking with me. Thanks, Dimitri. I appreciate it. I'm so glad you guys could be here. And yes, Jim, as always, Cynthia and IB are wonderful where they record and archive this and turn it around so quickly, along with all the documentations. So you have great access to this. I can't thank IB and personally Cynthia enough for giving us this venue to talk with you guys and share some insight into our products.
Well, Pete, I'm going to jump in here because I do have one piece of business while we're waiting for any additional questions, and that's IB's management always asks me to run a poll in each event. So notice I'm going to put that poll up on your screen. It's only there for about 30 seconds, but I do ask that you make your selections, and notice 2 questions are multiple choice. We try and keep this easy. But I do want to point out that question number 2 is don't put any questions for Pete there because we won't see these until after the event ends. But that makes a great field if you do have any comments or suggestions for other topics you'd like to have covered during this event. Simply enter them there. Once you've finished, when the poll did end, I usually try and give you a heads-up warning. But if it ended too quickly and you still have suggestions or comments, you can always send those to me at webinars@interactivebrokers.com. So thanks, everyone. We appreciate that. Now, I would like to take it back and see if there's any additional questions for today's event, and want to remind you that I saw some questions did come in about the recording, and yes, this has been recorded. Pete covered quite a bit here today, so I can appreciate you needing or wanting to go back and review some of those concepts. Simply watch your email later on this afternoon because I will be sending out a direct link to today's playback soon after the event ends. It normally takes me about an hour or so to compile and upload to our servers, but as soon as it's available, you'll be notified directly. Now, also, I noticed that Pete graciously included a lot of links to additional information, some tools, whether it is the QuikStrike for options, or actually the yield curve at treasury.gov. Now, all of those are included in the webinar notes that will appear as you exit today's session. It will also be posted on the Interactive Broker website along with today's recorded playback, and you can find that from the education menu. There's a webinar section and a button for recorded webinars. All of these and previous CME recordings are also available out there as well. Well, I'm not seeing any additional questions. I was trying to prolong just a little bit to see if we have questions come in. Pete, did you see any at your end?
I did not, Cynthia. You know what? I know we covered a lot, and you're right. I did. You know what? These are great products that afford you a lot of opportunities, but we definitely covered a lot of ground. So I just want to again thank everyone for staying with us and kind of taking this all in, and please feel free to reach out to me if you'd like, and I'd be happy to cover anything else with anybody if they're interested in getting a little bit more detail or clarifying something. And again, I just wanted to thank you for the opportunity to spend some time with Interactive Brokers, active trader population, and start to talk a little bit about these exciting products.
Well, thank you, Pete. And I also want to thank the CME Group because it's their dedication to educating traders that's actually bringing you today's event. Now, I mentioned early on that this is part of our year-long series on a School of Futures, and we're doing this each month on the different product groups that are available through the CME Group. Next month's topic is going to be handling the energy complex. Now, we do these on the fourth Thursday of each month. So if you have some time and want to join us, simply take a look. Again, under the education menu, there's that webinar section where you can sign up and register. Whether you attend live or not, you'll still get access to the recording and those webinars by simply registering. So with that, looks like we are going to conclude, and by my clock, exactly on time. So thank you very much, Pete. That was a lot to accomplish in just an hour. And I want to thank everyone else that's joined us today for your participation. We appreciate your time as well. So have a great day, everyone, and please remember all to trade smart. So thanks, everybody. Have a good one. By the way, you can exit using the X in the upper right-hand corner of the screen. Thanks, all.